Okay, so with the ROE versus the PE ratio and the PB ratio, okay, market to book and market expected earnings, okay, let's see how we can establish a relationship, okay, through the equation to analyze it, okay. So the ROE, simply by taking the earnings divided by the book value, that will also equal to the market price divided by the book value as a term, and then divide by another term by taking the market price divided by earnings. So we have simply by taking the PB ratio, PB ratio divided by PE ratio, and we have the PE ratio will simply be the market to book value divided by ROE. Okay, right. So that's the relationship between it. Concept check. What are GI? Okay, growth industries ROE in the year 2013. How do they compare to the industry average ratio, which were 8.64? Okay, so let's take a look. Okay, we have the data. Okay, on the side, 2012 and 2013. So the ROE by taking the net income divided by shareholders' equity, the net income in 2013 5,284. Divided by the shareholder equity, the average shareholder equity for the 2 years, 171,843 plus 177,128 divided by 2, we have 3.03%. Okay, right. So, so how do they compare to the industry average ratio, which were 8.64? Okay, then the ROE is at 3.03. What do you think? Okay. Because with the ratio that we just computed earlier, okay, we know that the growth industry is actually declining and they're not meeting the industry average. Okay, so we should really, develop some really good strategies to help to improve growth industry's performance. Right. So here at this table, let's take a look. Financial ratios for major industry groups. Right. Now, not all industries will have the same financial ratios. Okay, so it really depends on the industry itself, on the firms that are actually included in the industry. Okay, now for some countries, the industry might be finely segmented, but for some countries, because of the number of firms available in the sector, okay, they might be combining with different firms altogether. Okay, so it depends on the size of the industry and the numbers of firms in the industry. Here, let's take a look. We have all manufacturing, we have food products, we have clothing, printing, publishing, chemicals, drugs, machinery, electrical, motor vehicles, computer and electronic. Okay, so here let's take a look. We have the interest rate, interest coverage, the current ratio, okay, quick ratio, okay, asset turnover, profit margin, ROA, ROE, payout ratio, okay, and long-term debt asset. Okay, now can you tell us which industry will have a good performing long-term debt over asset? Okay, so here let's take a look. We have printing and publishing at 0.40, food product at 0.28, and electrical at 0.11. Okay, now how about for the interest rate coverage? Clothing, drugs, and machinery. Okay, we only choose the top 3. Okay, for you to compare the highest and the lowest. Okay, how about for the current ratio? Okay, current ratio. We find that clothing has the best current ratio, or the highest, okay, 2.26. For drugs, it's usually at 0.96, and for computer and electronics, it's 1.57. Okay, right. So we know that the cash position for clothing industry is actually very important because they need to have a higher current ratio compared to other industries. Now, how about for the quick ratio? Okay, quick ratio, we actually find out that it's not the clothing industry anymore, but actually it will be computers and electronics. Okay, they need to have a high quick ratio compared to electrical. Right? Asset turnover. Okay, which industry would need to have a higher asset turnover? We found out that it should be printing and publishing. This makes sense. Okay, because printing and publishing, we need to have a very high. Well, not high technology, but we need to have some advancements in technological investments, okay, to reduce the labor cost and to increase the printing efficiency, right? Okay, and we have drugs, okay, will be the lowest, okay, because usually in a drug, the asset turnover, okay, they'll be focusing a lot on research and development, okay, right? And then closing, okay, 1.25, okay, 1.25. Profit margin, okay, which industry will have the highest profit margin? Drugs, okay, 15.33, followed by chemical, 11.65, and motor vehicle only at 3.92, okay. The thing is because motor vehicle tend to be very affordable for normal households, okay, and it does not require a very high input in technology, and the production might be very standardized as a commodity, okay. But actually for drugs, okay, there's a high degree of research and development, and also for the patent, also for the innovation to treat different disease, okay, with a better outcome, all right. So drugs will have a very high profit margin. How about for the return on asset? Okay, return on asset. We find clothing and publishing, and also electrical with the lowest. Okay, but clothing and publishing will be the highest. Return on equity, we have clothing, printing, and also computer and electronics. Okay, right. And then we also have for the payout ratio. Okay, we have the electrical, motor vehicle, and computer and electronic. Okay, so with all these different financial ratios, which industry are you interested in investing? And which industry do you think that you need to focus on what type of specific financial ratios? Okay, so as an investor, you can select your criteria for investments. Okay, do you want to focus on the firm with the highest ROE? Well, that's what most investors will do. Okay, regardless of the industry. Okay, or you say, well, I have specific firms that I really like, I really adore. And then I want to, target on that firm only because I'm a loyal customer. Okay, that's fine too. Okay, it depends on your investment style, on your investment preferences. Okay, there's no single rule or regulation that will prohibit you from investing only in certain firms or not in certain firms. Okay, so we will enter into the section summary review. Okay, we have the ratio analysis for the leverage, okay, aspect. We have the interest burden, interest coverage, leverage, and compound leverage, okay, with the equations. EBIT minus interest expense divided by EBIT, EBIT divided by interest expense, and we have asset divided by equity equal to 1 plus debt divided by equity, and the compound leverage will have interest burden multiplied by leverage. Now, ratio analysis in terms of asset utilization, okay, how well or how efficiently I'm using my assets. So whatever fixed asset that I have purchased, they do not sit there and do nothing, okay? So total asset turnover, fixed asset turnover, inventory turnover, and days sales in receivable, okay? Total asset turnover, we take sales divided by average total assets, sales divided by average fixed cost, cost of goods sold, average inventories, and average accounts receivable divided by annual sales multiplied by 365 days per year, okay? Noticing days sales in receivable, we take 365 days because every day the bank would calculate interest rate on you. Right. So it's 365 days. For liquidity, in ratio analysis, we have current ratio, quick ratio, and cash ratio. Okay, so current ratio by taking current asset divided by current liabilities. Quick ratio, cash plus marketable securities plus receivables divided by current liabilities, and cash ratio by taking cash plus marketable securities divided by current liabilities. How about for profitability? Okay, return on asset, return on equity, and return on sales. Okay, we have EBIT divided by average total assets, net income divided by average stockholders' equity, and EBIT divided by sales. Market price, market to book value, price earning ratio, and earnings yield. Okay, we have price per share divided by book value per share, price per share divided by earnings per share, and we have earnings per share divided by price per share. All right. So with all the different segments of financial ratios, as an investor, you can target on the different aspects. Okay, and also according to the industry structure, industry characteristics. Different ratios will represent different aspects of the firm performance. Right, so after the summary review, okay, and after the session, can you answer the following questions? What are financial ratios? why analyze financial ratios, and how do I use financial ratios for investment decision. I'm Professor Yang. See you next time.